If you own a rental property with someone else, your spouse, your partner, a sibling, or a business associate, how you split the rental income for tax isn't a free choice. Get it wrong and you could be paying more tax than you need to, or worse, filing returns HMRC will challenge. In the next few minutes, we will show you exactly how joint ownership is taxed, the biggest mistake couples make, and what making tax digital now demands from co-owners. Start with the distinction that trips everyone up. Legal ownership versus beneficial ownership. Legal ownership is whose name is on the land registry title. Beneficial ownership is who's actually entitled to the income and the sale proceeds. Tax follows beneficial ownership. For married couples and civil partners who own jointly and live together, HMRC applies a default. Income is split 50-50 regardless of the real shares. To be taxed on your actual shares, say 70-30, because one of you put in most of the deposit, you must do three things. Hold the property as tenants in common, not joint tenants, have a declaration of trust evidencing those unequal interests, and file Form 17 within 60 days of signing. Miss the deadline and the election doesn't count, and the split on Form 17 has to match real ownership. For everyone who isn't married or in a civil partnership, cohabiting couples, siblings, parent and child, friends, business partners, there's no 50-50 default and no Form 17. You're each taxed on your actual beneficial share. So, if two siblings are on the title as joint tenants, the presumption is 50-50, but if one funded the whole purchase and there's a declaration of trust showing 70-30, the income follows 70-30. Why do so many get this wrong? Three reasons. First, they assume they can move income to whoever's in the lower band freely every year. You can't. Second, they try to use Form 17 on a 50-50 property to choose a different split, but Form 17 only works where the shares are genuinely unequal. Third, they change their split mid-year and assume it backdates to 6th of April. It doesn't. The new split only applies to income arising after the last signature. Let's make it concrete. David and Emma own 5 buy-to-lets. 3 buy-to-lets are owned 50-50, combined gross rent £60,000, so £30,000 each. The other 2 are 70-30 in David's favour after a proper Form 17 election, combined rent £40,000, £28,000 to David, £12,000 to Emma. Added up, David's qualifying income is £58,000, Emma's is £42,000. Under Making Tax Digital, that matters. David crosses the £50,000 threshold, so he's mandated from April 2026. Emma isn't mandated until April 2027, when the threshold drops to £30,000. Same 5 properties, 2 different MTD start dates. Income tax is charged on each owner at their own marginal rate on their share of the profit. That's why couples often want income weighted toward the lower earner, and structuring ownership legitimately can save real money. But watch the knock-on taxes. Transferring a beneficial share between spouses who live together is no gain, no loss for capital gains tax, so no CGT on that transfer. Between unmarried owners, a transfer can trigger CGT, and if the person taking the bigger share also takes on more mortgage, stamp duty can bite because assuming debt counts as consideration. HMRC can and does challenge income splits that don't match the paperwork. That's an incorrect return with penalties and interest. And under MTD, there's a specific trap. A passive co-owner who only sees the net share will often report that net figure. However, once you're inside MTD, that shortcut ends. HMRC's Create Digital Record guidance is explicit. Record the gross income before expenses and your expenses separately. Remember, there's no joint MTD account. Each co-owner signs up, records, files, and is penalized separately. 3 mistakes to avoid. 1. Splitting income to suit your tax bill with no declaration of trust and valid Form 17 behind it. 2. Leaving a property as joint tenants but reporting an unequal split. 3. As a passive co-owner, still reporting only your net share once you're inside MTD. So, what should you do? First, check how each property is held and whether it matches how you want to be taxed. Second, if you want an unequal split, get a declaration of trust drawn up and file Form 17 within 60 days. Third, make any change at the start of a tax year. Fourth, if you're the passive co-owner, ask for the gross figures now. Fifth, Keep the evidence, declaration of trust, Form 17, completion statements, ownership percentages in one place. And run the qualifying income test for each owner so you know who's mandated and when. Myth: we can split our rental income however we like. Reality: it must follow genuine beneficial ownership. And for spouses, it's 50-50 unless you've correctly elected otherwise. This is exactly what RentalBux is built for. Enter each property once, set the ownership split per property, any ratio, and it produces per owner records, quarterly updates, and final declarations automatically, applying Section 24 at each person's share. Start your free trial or book a demo and we'll show you how it handles your portfolio.